So we mentioned leases. Let's talk a little more detail about leases. A lease is nothing more than a rental contract. That's the easy part. Where it gets a little challenging is separating leasing into its two main elements. There's operating leases and capital leases. We want to be very clear here. If we go back 40 years or so, since a lease is a rental contract, we don't own the assets. Therefore, for many years, organizations would lease buildings, equipment, etc., and not have to show it on the balance sheet. The disadvantage was that the readers of the financial statement, whether it was investors or lenders or anyone else, really had no idea, looking at the balance sheet, what the actual obligations of the organization were. So accounting changed the rules about 40 years ago and said, if you are leasing something for a long period of time, if it qualifies as a capital lease, you must show it on both the balance sheet and the income statement. And what does that mean? That means if the lease meets any one of the four criteria at the bottom of the page, the life of the lease, in other words, the term, the number of years, is 75% or more of the useful life of the asset as accounting establishes the useful life, then we're required to call this a capital lease. And if we call it a capital lease, we must show the lease on the balance sheet under long-term assets, and it's referred to as asset under capital lease. And on the liability side, we must show the current portion, there's your current liability, as well as the long-term portion, the remaining obligation on the lease. So let's use a specific asset. We're going to lease a building for 10 years at $10 million. We're going to pay $1 million per year in a rental fee. That's a capital lease because the building probably has only a 15-year useful life or a 12-year useful life. If it meets any of these four criteria, the balance sheet will show under long-term assets, asset under capital lease, which would be the building for $10 million. On the liability side, we'll show current portion of lease obligation, $1 million. That's the amount of rent we're going to pay this year. The capital lease obligation long-term, in the long-term liability section, will show the $10 million less the $1 million current portion for a $9 million obligation over the remainder of the lease. That would be the balance sheet. The income statement would show at the end of the year the $1 million we paid in lease expense. So there's the tie-in. So if we have to capitalize the lease, that would be the approach. So if it met the first criteria, 75% or more of the useful life, it has to be capitalized. If the lease contains a purchase agreement for what's referred to as less than market value at the end, we're leasing a building for $10 million. At the end of the lease, we can buy the building for $100. 100 is such a small number. It very obviously is much, much less than what the building would be worth in the marketplace. That would be criteria number 2. Or criteria 3, the lessee, that's us leasing the building, we gain ownership at the end of the lease period. So the title, the ownership of the asset, is automatically transferred at the end of the lease. Clearly, it's a capital lease. And the 4th criteria, present value of the lease payments is greater than 90% of the asset's market value. The $10 million building, if we discount the stream of payments, the $1 million per year for the 10 years, at our cost of capital, and that's equal to or greater than 90% of the real asset value, it's a capital lease. So how do we take this? How do we look at this and make a decision? Accounting is very clear. If our lease, this rental agreement we make between us as the user or the lessee and the actual owner of the asset, the lessor, if that agreement meets any one of these four criteria, we are required to capitalize the lease. Because in effect, it is what's called de facto ownership. We're financing the acquisition of this asset through a lease instead of a loan, but it really is ours. We're just using that particular financing vehicle. Here's the good news, though. If we capitalize an asset, one of the ways we reduce the balance sheet value on the asset side is by actually taking depreciation on the asset exactly as if we owned it. So a capital lease is legally a long-term rental agreement, but it's as close to traditional financing or borrowing to finance the lease as possible. So accounting says, let's be honest. Let's be transparent. Let's show to the reader of the financial statement what we really have. So long-term asset, short-term liability, and long-term liability. We're going to be completely transparent on the balance sheet. We'll take the payments as an expense on the income statement. End of discussion. That by far is one of the more common forms of leasing globally. What we also see is operating leases. And an operating lease is very, very different from a capital lease. First of all, it's a gross lease, which means if we're leasing the asset, we pay one fee. The lessor takes care of insurance, transportation, installation, etc. We can expense the payments on the income statement, but there's no requirement to put the asset on the balance sheet, which is why this is called off-balance sheet financing. Operating leases are normally for short periods of time. It's an asset we need for a few weeks or a few months. We have no need or intention to have it long term. So if it's a piece of equipment or it's an extra facility for a few months, we sign a very expensive short-term lease because we need it, done. That's an operating lease. Almost any other form of leasing, certainly long-term and meeting any one of the four criteria, is a capital lease. Now, both GAAP and IFRS are having some discussions about having more exposure, more clarification in footnotes about operating leases, or let me put it this way, capital leases that are pretending to be operating leases. The rules have changed in the last 2 years, and they're about to change again once IFRS and GAAP decide on the final rulings. We'll come back to you with an explanation on that. So we've been talking about costs or expenses in a general sense. Let's take a quick look at these as real tools to understand the business at a little deeper basis. Costs can be broken down into one of three areas. Fixed costs, those that don't change with changes in our volume. Variable costs that are change in direct proportion to the increase or decrease in what we produce. And mixed costs, those that have elements that are both fixed and variable. And this is important because one of the tools we want to look at is calculating a break-even. And in order to do that, we need to separate and identify our fixed costs from our variable costs. And for every organization, product or service, public or private, total costs equal our fixed cost plus our variable costs. And fixed costs are not unchanged forever. Fixed cost is the term we use in finance to refer to costs that are not linked directly to production. They're more tied to the calendar. So insurance frequently is for a given period, like a year. Salaries, overhead expenses. These costs are generally fixed for a period of time, most commonly a year, and then there'll be some adjustment for then a subsequent period. So whether our production goes up or down does not impact our fixed costs. And these are also called period costs because they relate to a period of time rather than a volume, or indirect costs because they do not go into the product or service directly. So if you remember on the income statement, we had cost of goods sold and we had operating expenses. Fixed costs are almost always operating expenses. Variable costs, on the other hand, which are referred to as direct costs because they go directly into the product or service. And we've got also product costs for the exact same reason. Variable costs are costs that move proportionally to our production. As production increases and decreases, the variable costs increase and decrease. So think of it this way. Direct labor that goes into our product or our service, materials, our marketing and advertising that create the actual sale. Those are variable costs. As our costs relate proportionally, as production increases, as our sales increase, our variable costs increase. So fixed costs remain over a period of time. Variable costs move up and down with production levels. So if we look at this on a graph or on a linear basis, think of our vertical axis as our total cost and our horizontal axis as the number of units. We have our fixed cost as the brown horizontal line here. We can look at our variable cost increasing over a volume. So as we move from left to right, our variable cost will increase in total as we produce and sell more units. When we add the variable costs on top of the fixed cost, you can see this diagonal line. This is generally what we see over time when it comes to the relationship between our fixed costs, our variable costs, and our total costs.